Imagine this. Overnight, millions of dollars shifted hands. Trillions of dollars of global wealth moved, not because of a new technology, not because of a corporate earnings report, but because of one event in a faraway country most Americans can barely locate on a map: Venezuela. The news broke. Nicolás Maduro, the leader who had dominated Venezuela for over 2 decades, was suddenly captured. And Wall Street reacted like a storm had hit. Stocks surged, bond markets went wild, hedge funds made massive bets, and ordinary investors were left scratching their heads, wondering what just happened and why does it matter to me? In the next 45 minutes, we are going to trace the domino effect of this event, not through headlines or sensationalist speculation, but through patterns, history, and the economic logic that underpins global markets. By the end, you'll understand why Wall Street went wild and why this might only be the beginning of a much larger story. Stay with me. Here's the thesis. Whenever a sudden geopolitical shock occurs in a country with significant natural resources and systemic economic instability, global financial systems react in predictable ways. This is not random. This is pattern-based. History shows us that market surges following political upheavals are rarely about optimism. They are about perceived opportunity and risk recalibration. Investors, traders, and institutions move before reality settles. And in the case of Venezuela, the stakes are immense. The country controls some of the largest proven oil reserves on the planet, a complex web of sovereign debt, and a political structure that has long defied external influence. The events of the last week are a textbook example of these dynamics, but with an unprecedented twist. Let's start with Wall Street. The moment news of Maduro's capture spread, markets responded with what analysts describe as a short-term euphoria. The Dow Jones Industrial Average surged over 700 points in a single day. Energy stocks, particularly U.S.-based oil firms, jumped sharply. Hedge funds with exposure to Venezuelan debt reported extraordinary gains. Bonds issued by Venezuela and its state-owned oil company, PDVSA, which had been trading at distressed levels, spiked almost 30% overnight. Why? Because markets are forward-looking, and in this case, investors immediately recalibrated the probability of Venezuela re-entering global oil supply chains. The mere perception that the country might stabilize, even partially, was enough to trigger massive buying. Here's the pattern. Markets do not wait for certainty, they respond to possibility. And this is a point worth emphasizing. The market's reaction was not a reflection of Venezuela suddenly becoming economically stable. The country is still facing hyperinflation, decimated infrastructure, and political unrest. But financial systems interpreted the capture as a signal that could open doors for capital flows, corporate contracts, and asset recoveries. Here's the part nobody talks about. Not all the money gained overnight came from Wall Street analysts predicting stability. Much of it came from complex derivatives and leveraged positions, bets layered on top of bets. Some hedge funds had essentially been waiting for any sign of change for years, and the moment came. The question is, who really wins when such bets pay off, and who silently loses, often without headlines? We'll return to that in a moment, but first, let's step back and understand why Venezuela, a country in crisis for over a decade, can still make Wall Street move like this. To understand the present, we must look to the past. Venezuela was once one of the richest countries in Latin America. Oil wealth fueled rapid urbanization, infrastructure development, and social programs. By the 1970s, Venezuela was considered a stable democracy with one of the highest per capita incomes in the region. Then came a pattern we've seen repeated in resource-rich countries. Boom, dependency, mismanagement, and collapse. Oil prices fell sharply in the 1980s, debt accumulated, and populist governments introduced policies that slowly eroded investor confidence. By the late 1990s, Hugo Chavez emerged promising a redistribution, nationalization, and a new vision of sovereignty. Fast forward to Maduro, Chavez's successor. The same patterns continued: hyperinflation, currency collapse, and state capture of strategic assets, particularly in energy. But one factor remained constant. Venezuela's oil reserves never disappeared. The world still needed them. Here's the takeaway. Even in countries with systemic collapse, natural resources act as a gravitational pull for global capital. History proves that wherever there is scarcity in combination with high-value resources, markets will eventually respond to political shocks. Think about this. Every time a sudden leadership vacuum appeared in Venezuela, there were brief moments when markets surged, only to retreat when instability returned. This is exactly what we saw this week, but with a stronger, more pronounced spike. Why? Because the global context is different today. Oil prices are high, energy demand is unpredictable, and geopolitical tensions make alternative sources uncertain. In other words, the system itself amplifies the reaction. Let's break it down, stage by stage. Stage 1, news breaks. Traders, algorithms, and financial institutions absorb the information, prices of Venezuelan bonds and derivatives instantly adjust to reflect perceived opportunities. Stage 2, hedge funds that had been shorting certain instruments begin covering positions. This generates a secondary spike. It's a feedback loop. Buying leads to more buying. Stage 3, energy markets react. U.S. oil companies are suddenly priced as if Venezuelan oil may soon be available to international markets. Oil futures rise, ETFs adjust, and every fund linked to energy sees ripple effects. Stage 4, media amplification. Financial news channels broadcast the surge. Retail investors see headlines like "Markets soar on Venezuela news," and the fear of missing out accelerates buying. The point is not to scare you, but to highlight inevitability. Market surges are not random. They follow predictable human and systemic behaviors. Here's something crucial. Not all investors are playing fair, or even openly. Some of the biggest gains come from positions that exploit information asymmetry. In other words, certain funds could anticipate market reactions before the news fully hits the public. This introduces a hidden layer to the story. The capture of Maduro didn't tease, just move markets. It revealed how much of Wall Street operates on patterns, perception, and speed rather than fundamentals. To understand this further, consider historical parallels. In 1979, the Iranian Revolution caused oil prices to spike and markets to surge. Investors who correctly interpreted the unfolding political crisis profited massively, despite decades of instability in the region. Similarly, during the collapse of the Soviet Union, sudden leadership changes triggered waves of speculative investment in energy and commodities, even while the actual economies were fragile and unpredictable. The pattern repeats. Political shocks in resource-rich nations temporarily realign market expectations. And Wall Street responds faster than any government, any central bank, or any news outlet. Think about this for a moment. If a single political event in a small country can trigger trillions in market movement, well, what does that say about the fragility and the opportunity built into the system? Most people miss this. Most think it's random. But the system is methodical. It rewards those who anticipate patterns and punishes those who react too slowly. Now let's bring it down to human scale. Hedge fund managers celebrated gains in the hundreds of millions. Retail investors who got lucky rode the wave for a brief fortune. But Venezuelans themselves, the citizens living through decades of hyperinflation, saw no immediate change. This contrast is stark and deliberate. The system does not care about fairness. It responds to incentives and information. Historical parallels show us this is not new. Resource shocks have always benefited those with capital and access, often leaving ordinary citizens behind. Here's an uncomfortable truth. Wall Street, S reaction, is almost entirely decoupled from reality on the ground. And yet, the headlines scream as if the world has changed overnight. But here was the twist, and the part that gets overlooked. Not all the movement in markets was about oil. A second, less obvious force was at play: Venezuela's sovereign debt and the derivatives linked to it. If this is making sense so far, stay with me. The next segment uncovers the mechanics behind the hidden money flows and why understanding them could change how you view global markets forever. Now, we go deeper. We explore the hidden financial mechanisms, sovereign debt maneuvers, and derivative trades that move trillions almost invisibly, and why these forces make this situation unlike any prior geopolitical shock. By the end, you'll see how a single political event can ripple through global markets in ways that ordinary headlines never explain, and why history suggests the next chapter is already unfolding. To understand the financial reaction, we need to start with Venezuela's debt. For years, Venezuela issued bonds to international markets. These bonds were often distressed, meaning investors saw a high probability of default. Hedge funds, sovereign wealth funds, and other institutional investors have been buying and selling this debt for years, betting not on Venezuela's current economic health, but on future events that could change perceived value. The capture of Maduro represented such an event. Suddenly, the perceived probability of restructuring or partial repayment increased. Overnight, bonds that had been trading at fractions of their face value spiked dramatically. Here's a pattern worth noting. Every major political upheaval in resource-rich, debt-laden countries tends to create temporary arbitrage opportunities. Traders who understand historical patterns anticipate these spikes long before the general public reacts. In short, Wall Street doesn't need Venezuela to stabilize. It only needs the perception that the system might change. Here's the part nobody talks about. Some of the biggest gains weren't teed from Venezuelan oil or even traditional equity markets. They came from synthetic derivatives tied to bond performance. These are complex financial instruments where a single change in market perception can generate enormous gains, often without the underlying asset ever changing hands. Imagine making billions based purely on expectation, perception, and timing. That's what happened this week. And it raises a key question. If you can profit without touching the actual economy, what does that say about the markets themselves? To fully grasp the scale, we need to break down derivatives and leverage. Derivatives are contracts whose value is derived from an underlying asset. In this case, many derivatives were tied to Venezuelan bonds or energy contracts. Hedge funds and institutional investors were holding layered bets, which are essentially bets on top of other bets. Leverage amplified these movements. A small perceived improvement in political stability, such as Maduro-esque capture, triggered a cascade effect. Derivatives gained value, which required adjustments in related positions, which then fed back into the bond and equity markets. Think of it like dominoes stacked in multiple layers. One small nudge can trigger movements that seem outsized compared to the original event. Historical pattern check. In 1997, during the Asian financial crisis, hedge funds used similar mechanisms in Thailand and Indonesia. Minor political or economic shifts triggered outsized market movements. History repeats, but with modern complexity. The stakes are higher and the ripple effect is global. Here's something to consider. In 2008, Lehman Brothers' collapse triggered a cascade of derivative defaults across global markets. The underlying assets were real, mortgages, loans, but the chain of perception-driven leverage magnified the effect. Fast forward to Venezuela, the underlying economy is fragile, hyperinflated, and chaotic. Yet the global financial system treated it as a mechanism for real-time opportunity extraction. This is why understanding patterns, not just news, is critical. Markets react predictably, even when the real economy is unpredictable. Let's now return to oil, which appears on the surface as the main driver. When Maduro's capture was announced, U.S. oil companies and energy ETFs surged. Headlines screamed about Venezuelan oil returning to markets. But in reality, Venezuela's oil infrastructure is still largely decayed. Pipelines leak, refineries are offline, and production capacity has been declining for years. The spike wasn't a reflection of immediate supply, it was anticipation. Markets assumed that eventually the political shift could lead to contracts, foreign investment, or partial production recovery. Historical parallel. After the fall of Saddam Hussein in Iraq in 2003, oil futures jumped, despite the fact that infrastructure was heavily damaged. Perception drove prices long before reality caught up. Here's the twist. What investors anticipated isn't guaranteed. The spike represents opportunity, not certainty. And when opportunity is priced as reality, corrections can be swift and severe. Beyond markets, consider the geopolitical implications. Maduro's capture didn't just shift Venezuelan politics, it recalibrated relationships across Latin America, Europe, and the US. Sanctions may loosen. Trade negotiations could accelerate. Foreign investment in energy projects might suddenly become feasible. But here's the pattern we've seen repeatedly. Political interventions in resource-rich nations often trigger a chain reaction. Neighboring countries' currencies, bond yields, and stock markets respond. Supply chains shift, even global oil futures, including Brent and WTI, adjust immediately. It is not just Venezuela, it is the entire regional and global system reacting to a single event. Ask yourself this: if a country producing just 2 to 3% of the world's oil can trigger such massive market movement, how fragile is the system when multiple events overlap? And more importantly, how much of your portfolio, retirement fund, or exposure is unknowingly linked to these patterns? To fully understand why Wall Street went wild, we need to touch on human behavior. Markets are systems, but humans run them, and humans overreact to sudden, high-impact events. Behavioral economists call this news-driven overcompensation. Investors see a sudden geopolitical event, assume maximum impact, and act aggressively. This explains the initial surge, often disconnected from the long-term reality. Historical examples abound: the 1987 Black Monday crash, the 1997 Asian financial crisis, the 2022 energy shock in Europe. In each case, the first reaction was overcorrection, followed by a recalibration as facts became clear. Venezuela is no different. The initial Wall Street spike is a classic overreaction, but it is profitable for those positioned correctly. Here's the crucial insight. The systems that amplified this spike, derivatives, leverage, perception, are fragile and interconnected. One miscalculation, one sudden policy reversal, and the same systems could swing violently in the opposite direction. This is where history teaches us markets are predictable in patterns, not in timing. The gains today could precede instability tomorrow. Let's summarize some patterns we've observed across decades. Political shocks in resource-rich nations trigger short-term market surges. Derivatives and leveraged positions amplify these movements. Investor perception often outweighs reality. Global ripple effects extend far beyond the country in question. Short-term winners rarely correlate with long-term local recovery. The same pattern repeats from Iran in 1979, Iraq in 2003, the Soviet Union in 1991, and now Venezuela in 2026. Understanding these patterns allows us to interpret events rationally rather than emotionally. What does this mean for everyday people? First, Understanding the mechanics behind these movements is more important than following headlines. Markets react to perception and expectation, not truth. Second, global financial systems are highly sensitive to small geopolitical events. What seems distant can have real-world impact: oil prices, retirement funds, even mortgage rates. Third, history shows that volatility is inevitable. Patterns repeat, but timing is uncertain. Those who understand systemic patterns, rather than chasing news, are the ones who benefit. Finally, this is not a call to panic, but a call to awareness. Knowledge of patterns gives perspective, and perspective allows better decisions. Here is the part that keeps many people up at night. Even though this looks like an isolated spike, the underlying forces are permanent and interconnected. The systems that amplified gains can just as easily amplify losses, and history shows us that volatility often comes in waves, not single events. So, what really happened after Maduro's capture? Wall Street went wild, yes. Stocks surged, bonds spiked, hedge funds profited. But the underlying reality, decayed infrastructure, hyperinflation, political instability, remains. This is the pattern we've seen throughout history. Markets react faster than reality. Perception drives value. Opportunity exists alongside risk, and the ripple effects extend far beyond the headlines. What comes next is uncertain, but understanding the patterns allows us to anticipate rather than blindly react. If you want more in-depth analysis of global financial systems, geopolitical shocks, and the hidden patterns that drive markets, subscribe. This is not about headlines or opinion. It's about seeing the system as it really is. And remember, history doesn't repeat itself exactly, but it often rhymes. Think about that and reflect. In a world where perception can move trillions, how prepared are you to understand the next ripple? The story is far from over. Venezuela remains a flashpoint, markets remain fragile, and the world watches, anticipating the next move. Will perception align with reality? Will systemic patterns trigger another surge or collapse? Only time and careful observation will tell.